Have you ever wondered how to grow your wealth in a way that truly honors your faith and avoids forbidden practices like interest? Checking debt ratios is a fundamental and absolutely crucial step for anyone seeking to invest in a halal or Sharia-compliant manner. This is because Islamic finance strictly prohibits riba, which is interest, and discourages excessive debt, particularly that which involves interest-bearing loans. Companies with high levels of interest-based debt are generally considered non-compliant with Islamic principles, regardless of how ethical their primary business might seem. Screening for debt ensures your investments avoid involvement in these prohibited financial practices, upholding the core values of Sharia. To begin, you will need to examine a company's financial statements, specifically its balance sheet, or use financial data providers that often present these ratios. The two primary debt ratios to focus on are the total debt to total assets ratio and the interest-bearing debt to market capitalization ratio. For the total debt to total assets ratio, calculate the company's total liabilities divided by its total assets. Many Sharia screening standards, including those from the Accounting and Auditing Organization for Islamic Financial Institutions, or AOIFI, generally suggest that this ratio should not exceed 33%. This helps to ensure the company's financial structure is not heavily reliant on borrowing. Next, for the interest-bearing debt to market capitalization ratio, you will take all interest-bearing debt, such as bonds and conventional loans, and divide it by the company's total market value, which is its share price multiplied by the number of outstanding shares. Again, a common threshold is for this ratio to be less than 33%, highlighting that interest-based obligations should be a small portion of the company's overall value. It is important to remember that these ratios are part of a broader set of Sharia screens that also look at prohibited business activities and the proportion of impermissible income a company generates. Some scholars might also consider a slightly different ratio like total debt to equity. By diligently applying these debt ratio checks, you are actively participating in ethical wealth management, ensuring your investments are aligned with your faith and contributing to a more just and responsible financial ecosystem.